Ladies and gentlemen, welcome back. This is Christopher Aaron. It is April 24th, 2024, and I want to do something a little bit different today. We're going to talk about the gold and silver breakouts that are occurring now. However, I want to share with you some of the lessons that I learned in the global financial crisis of 2008 and how those lessons apply to the breakouts that we're now seeing in gold and silver. So that's what we will cover today. Make sure to hit the subscribe button so that you're notified when these videos come out and the bell icon. And if you have a moment, if you'd like to leave a thumbs up, I really appreciate that. Helps out the algorithms here on YouTube. Last but not least, make sure to follow us on Twitter or X at iGlobalGold. Sometimes I post quicker updates for free on that X platform when I don't have time to post here on YouTube. Okay, let's get into this update. Here is the legal disclaimer for one moment. Now, let's rewind back to the 2008 global financial crisis. What we're doing here is looking at the same scale for all four of these different markets. We're looking at the S&P 500, US stock market, upper left, gold, bottom left, silver, upper right, and the gold miners index. This is the HUI unhedged gold miners. There are some silver miners in this index as well. So it's a good representation for the average of the large cap gold and silver miners here on the lower right. So I want to rewind in case you did not live through the global financial crisis, if you simply were not paying attention to the markets back then, or if you're too young to remember that. I want to let you know that this is when I really started actively investing in the markets, actually in the mid-2000s, but really leading into 2007, and then I became very active in 2008 during the global financial crisis, and I took extensive notes, and I want to share some of that with you here. So just to rewind right here, at the peak of the stock market in 2007, this is when the subprime crisis really began to break out. And I began to notice this actually in 2005, 2006. I remember a lot of my coworkers at my first job when I graduated college. I graduated college in 2003. And in my first job, 2005, 2006, a lot of my coworkers who were on more or less entry-level salaries at the time were just absolutely obsessed with this idea that if they just bought a condominium or a townhouse and waited for 3 years, that they would become rich, that the townhouse was going to double or triple in value, and that all one had to do was buy real estate and you would become rich in just a few years. This was the common belief, believe it or not, in 2004, 2005, and 2006, leading up to the subprime crisis. Okay, so this initial down move here in 2007 was the subprime crisis. At the time, a lot of analysts were saying that the subprime is going to be contained. It's just related to loose lending standards, but it's not going to impact the general economy. That's what they were saying here in 2007. Then we had the beginning of the more severe part of the collapse in the first part of 2008. This is when Bear Stearns, the large bank and hedge fund, went under in March of 2008. It's when Fannie Mae and Freddie Mac went under. It's when several of the other banks started to go bankrupt, and the Fed had to step in and bail a lot of them out. And so notice here in March of 2008, this is exactly when gold peaked. Now, at the time, this peak here in gold, just above $1,000 per ounce, was a new all-time high. You have to remember this. At the time, no one alive on planet Earth had ever witnessed the gold price being higher than $1,000 per ounce. And I remember this to the day. It was all over the news. People were talking about it. Some people were saying, hey, is gold going to go to 2,000 next? Is gold going to go to 5,000 next, right? No one knew because this was the highest price ever recorded. At the same time, silver hit this price above $20 per ounce. It touched almost $21.50. And remember, this was the first time in 28 years that silver recorded a level above $20 per ounce. You have to go all the way back to the year 1980, the last time that silver was above 20. So you better believe this was a key moment. Bear Stearns collapse, gold new all-time high, silver back above 20. And then what happened in the gold miners at that time is that they were up 13x in 7 years. From the lows here in 2001 up to 520 on the index, from 40 to 520 on the index. A 13-fold move in 7 years. So this is why we invest in the gold mining companies and the silver mining companies. You can see here as the price of gold quadrupled from 250 up to 1,000, the miners were up 13-fold. Okay. So at the time, at this exact moment in history, there were many fundamental analysts out there who were saying that things are going to get worse, that this Bear Stearns collapse was only the tip of the iceberg, that there were more banks that were going to go under, there were more hedge funds that were going to go under, that the Federal Reserve was going to bail them out, they were going to print money out of thin air in order to bail out all these institutions. They said things are going to get worse, the subprime crisis is going to spread to other parts of the economy, and therefore buy gold, silver, and the miners to protect yourself. There were many fundamental analysts. I'm not going to name their names. You can go back and look. You can do a Google search. I don't want to make any enemies out there, but let's just say some of the quasi-famous names out there that you and I both know who we are talking about. This was their logic at the time. Things are going to get worse, therefore buy gold, silver, and the miners. And I want to now fast forward these charts by only 6 months. Watch this. And let's record what actually happened in the global financial crisis. So these fundamental analysts were right about the general stock market. The general stock market fell 54% from the peak in late 2007, 1 year later, October of 2008. That is a significant crash. However, what happened to the price of gold at the same time? From that peak above $1,000 per ounce, gold fell down to $680, a decline of 35%. Okay, so at least you were better in gold than the S&P 500 or general stock markets. However, you still lost money in the crash. Then look at what happened with silver. Silver fell from above 21 to almost $8 per ounce. It was exactly a 60% decline. So if you were listening to these fundamental analysts and they were correct about the spreading of the subprime crisis, because what happened 6 months later is that Lehman Brothers went under, Wachovia Bank went under, Merrill Lynch Bank went under, Bank of America had to be bailed out, Citibank had to be bailed out, General Motors had to be bailed out. So they were right on the global financial crisis, but they were wrong on how the global financial crisis would impact the markets that they were recommending for people to buy. You lost more money by, quote unquote, protecting yourself in silver than if you had just been sitting in mainstream stocks. Can you believe that? And then we want to talk about the gold miners. Look at this. In 6 months, they fell 72%. My goodness. Okay, so these fundamental analysts, once again, they were correct on things getting worse. They were correct on the subprime crisis spreading, but they were totally wrong on how those series of fundamentals would actually impact the price of the asset classes that they were investing in. Okay. Let's bring up a few more gold and silver miners here. I want to really hammer this point home so you see why this type of analysis is so dangerous. Silvercorp Metals, mid-tier silver mining company. Look at this. Global financial crisis down 91% in 6 months. You think this is an isolated case? New Gold, formed in 2005, down 93% in 6 months. Impact Silver, a company that we own today and that I think is going higher over the next few years, fell in the global financial crisis by 94% in 6 months. Are you kidding me? So if you think that you've lived through volatility over the last 6, 12, 18 months that you've been involved in the precious metal sector, you haven't seen anything. Those of us who lived through the global financial crisis literally saw, well, if we listen to those fundamental analysts, we literally saw our portfolios fall by 90 to 98%. You think maybe that's only the junior miners? Look at what happened to the seniors. This is Wheaton Precious Metals, one of the best diversified mining companies or streaming companies on the face of the planet, fell in the global financial crisis by what? 86% in 6 months. This was an utter disaster. If you listen to those people who were correct on the global financial crisis, but they were diametrically wrong on how it would play out on the assets that were supposed to protect them, okay? You cannot trust the fundamental analysts to get the actual outcome correct. That is the takeaway. Now, in late 2008, I found myself in a very peculiar situation where I was actually able to buy shares of Wheaton Precious Metals. I kid you not. I bought some shares, not all my shares. I'm not claiming to have timed the exact bottom perfectly with 100%. But I bought a significant chunk of my shares at $2.75. I have the transaction recorded back in the crash of 2008. Why? How did I manage to do that? I will tell you how. I was stationed in Afghanistan with the military in the crash of 2008. This was my daily life. Here's me with a bunker behind me in the barracks with the military where I lived and slept in the same barracks with the soldiers. Here's me near the runway where I worked next to the military jets, okay? I was in Afghanistan at the peak of the global financial crisis in 2008, and I literally had nowhere that I could spend the money that I was earning there. It was not possible because there was nothing to do there other than to work and go to the gym and then go to sleep and do that every day for 12 hours a day for 6 months straight. And so I just decided, you know what? I'm going to start buying some of these companies that have crashed in the global financial crisis, and I'm going to hope for the best. I said, if the world's about to end because these companies have fallen by 90 or 95%, well, then, we're all toast. So I might as well try to see if things are going to correct themselves. Let's fast forward this chart by the next 2 years. There was that 86% decline. Here's where I was buying some shares when I was literally stationed in the war, the global war on terror. And here's what ended up happening over the next 2 years. This is how I made my first small fortune. In the years following the global financial crisis, Wheaton Precious Metals rose by 1,845%. And I owned, of course, some miners that didn't do as well as Wheaton Precious Metals, but I also owned some that did even better. I am not joking you. So that's how I made the first fortune that I've ever made in my life, at least for myself at the time, coming back to the United States in 2009. Now, I said to myself at that time that I was never going to trust the fundamental analysts again. This is the moral of my story, because what if I hadn't been so fortunate as to have volunteered to go overseas to Afghanistan, to have this stable job, and to have the opportunity to buy these gold and silver miners that had fallen by 90 or 95%? What if I hadn't had that opportunity? What if I had been one of the unfortunate people that had been laid off during the global financial crisis? Or what if I had been so unfortunate to work for one of those many banks that went under, such as Wachovia, Bank of America, Citibank, Wells Fargo, all the ones that had to be bailed out, right? What if I didn't have the opportunity to take advantage of those stocks that crashed and then rose again after the crash? I told myself that I would never trust these fundamental base analysts ever again. And here are the reasons why. Fundamentals, let's remember, what are fundamentals? They are the causes for why markets move in a certain direction. However, there are infinite fundamentals. Yes, I am not exaggerating. There are infinite fundamentals because the fundamentals are everything that every man, woman, and child who has ever bought or sold or thought about buying or thought about selling a specific asset class have ever thought in their entire lives, leading them up to the point where they make a certain decision. And the fundamentals are all of the world events that have ever transpired in the history of planet Earth to cause a certain asset, to cause a certain commodity to have a certain level of supply or a certain level of demand. So we have to literally rewind to the beginning of planet Earth and the beginning of the universe as we know it in order to count all of the fundamentals that impact the gold price, the silver price, or the price of any other asset. There are, and I am not exaggerating, infinite fundamentals impacting the market. If you're a student of mathematics, you will know that any number divided by infinity is equal to 0. Therefore, forecasts that are based on any number of fundamental analysis divided by the total number of fundamentals have 0 predictive capacity. Not some predictive capacity, not a little bit of predictive capacity, 0 predictive capacity. There is 0 benefit to studying the fundamentals if one wants to be correct on the price. If one wants to have discussions and debates, and one wants to go on interviews and CNBC on the TV and sound like they know what they're talking about, then studying the fundamentals can have a value to it. But if you actually want to be able to predict the price, which is the most important thing, because it was, as we saw in that previous example, ignoring the price can lead to 90 to 95% drawdowns, even in the quote-unquote safety assets of the precious metals. If we want to ignore the price, then go ahead. Study the fundamentals for the rest of one's days. But I told myself I would never do that myself. However, every buy or sell decision impacts the price. The only place where all of the fundamentals converge is therefore the price. The price of the asset is the single place in space and time where all of the decisions, all of the factors coming into a market converge. And therefore, by studying the price, we can observe the sum of all the fundamentals at the same moment in time. This is the most critical point to understand about the type of analysis that I do. Price analysis, as we call it, or technical analysis is another term for it. By studying the price, we can observe all the fundamentals. However, if we choose to cherry pick 1, 2, 5, 10, 100, or even 1,000 fundamentals, even though all of those fundamentals may be correct, the sum of that is divided by infinity and therefore has 0 predictive capacity. We must study the price. And so, when we bring up a price chart, which is what we do here at iGold Advisor, and we study the trends in price, and we can see that for 1, 2, 5, or infinite reasons, sellers of gold are appearing along a certain trend. when we look at the generational time scale, we must absolutely pay attention to where those sellers are emerging. Whether they are legitimate sellers, whether they are traders, whether they are manipulators, whether they are central banks, whether they are hedge funds, whether they are your neighbor buying or selling gold coins, all of them converge right here, right at the price. This is it. The price analysis is so simple that most people will not believe it. They will choose to not believe it. They will choose to spend their entire lives chasing down rabbit holes of fundamentals that have zero predictive capacity to impact what they, in fact, most want to know, which is what is going to happen to the price. Price analysis is so powerful that it will change lives. It has changed my life, and if you continue to study it with us, price analysis will change your life. It is the only place where all of the fundamentals converge. And so right now, where all of the fundamentals converge, it is no coincidence that gold is struggling here to get above 2,400. 2,400, we can see, is this 50-year resistance line. We do have reason to believe that eventually gold will be going higher. However, not right now. The first thing that's going to happen is a pullback. And the price analysis, the simplest explanation, to borrow from Occam's razor, is what shows us that is usually the correct one. Let's remember this. The simplest explanation usually ends up being correct. If you would like to study price analysis with us every single week, not just looking at what to expect over the generational time scale, but what to expect for the rest of this week, what to expect next week, what to expect next month, not only in the gold price, but also in the silver price, also in Bitcoin, also in the stock market, also in the currencies, and also in other commodities, you should join us in Precious Metals Intelligence Plus. This is the sum of my life's work related to price analysis for precious metals and related markets at this time. I developed this service because of how badly I was hurt during the global financial crisis, because I listened to fundamental analysts and they were completely wrong in the global financial crisis. They're going to be completely wrong again when gold forms its next top. We must study the price. Remember, not only do we cover the physical metals themselves, we also send you flash updates when we make a buy or sell decision based on the price in any miner or any asset class that we are investing in here. That goes right to your email. Price analysis. If you are a higher net worth investor, you have to know that we take this price analysis, we then put it onto specific mining companies that we are investing in here, myself and my colleagues. And then we go and we negotiate terms with the mining companies so that we can get more favorable terms when we buy shares. So oftentimes we buy shares at a 15 or a 20% discount compared to how you can buy the shares in the open market. And then we also receive free warrants with every single investment that we make. And the warrants get us nearly twice the upside compared to buying those same companies in the open market. So that's for higher net worth investors. Remember, you get a free subscription to our flagship Precious Metals Intelligence Plus if you join us in our elite service. If you would like to apply price analysis to your situation, book a consultation on our website. We sit down, I speak with you one-on-one, just how we're speaking today. Except I listen to you, I take all your information, and I give you from a researched, independent perspective, what would I do if I was in your situation? given everything going on in your unique situation. So you can book that right there on the website. Guys, sooner or later, you will come to the point in your investment career where you realize that you cannot trust the fundamental-based analysts. And it will either happen because you see the wisdom in this type of philosophy, or it will happen once you experience a catastrophe in your investment portfolio where you lose 90 to 95% of your net worth in that portfolio because you have chosen to listen to the fundamental-based analysts who do not pay attention to the most important thing, which is actually the price. Join us in studying the price of gold, silver, and the gold and silver miners.